webinar will begin in 1 minute. And welcome, everyone. We're pleased that you have joined us for today's webinar titled The IRS Dirty Dozen. The webinar will last approximately 20 minutes, and at the end, you will be given an opportunity to receive supporting materials by email, free of charge to you. You will also be told how you may email questions related to today's content to the presenter. Today's presenter will be Jennifer Lawler. Jennifer is a senior consultant with Advanced Underwriting Consultants with a background in working with small business owners on their tax issues. Jennifer will draw on her experience in today's talk and will probably share an anecdote about a professional experience with one of the items on the Dirty Dozen list. Take it away, Jennifer.
Thanks, Linus. For today's webinar, like Linus said, we'll be discussing the recently released IRS Dirty Dozen list. This list gives us an idea of the kind of things that the service is wary of. But before we get into a lot of detail on the list, let's decide what we're going to discuss next month. We've set up a little poll so that you can help us pick a topic for next month's webinar. Give me just a second and we will get it up there. So the possible topics are recent developments in 60-day rollovers, answering the most asked questions about Medicaid planning, and the answers we just can't give. We'll give everybody a few minutes to complete the poll, and then we'll move on. Looks like we're getting pretty close. Anybody else want to vote? We'll give you a couple more seconds to do so. Looks like we need a tiebreaker. All right, we will call it done. Next month, we will be talking about recent developments on 60-day rollovers. But back to today's topic, the IRS's Dirty Dozen list. Every year, the IRS publishes a list of schemes and scams that are on its radar. The 2018 list was released on March 21 of 2018. The list is intended to warn taxpayers about schemes that might put them at risk. These scams and schemes can affect taxpayers of all ages and experiences. Most of these will tend to increase around tax time because of the nature of them, but taxpayers should be on alert all through the year. The full list can be found on the IRS's website, listed on this slide. For anyone that's interested in this link, we will post this webinar on our YouTube channel later today, and if you'll send us an email requesting backup information, we'll get that emailed to you as well. Now for the list. Number 1 is phishing. Number 2, phone scams. Number 3, identity theft. Number 4, return preparer fraud. Number 5, fake charities. Number 6, inflated refund claims. Number 7, excessive business credits. Number 8, padding deductions. Number 9, falsifying income. Number 10, frivolous tax arguments. Number 11, abusive tax shelters. And number 12, offshore tax avoidance. Pretexting is lying to obtain important personal information that would otherwise not be widely available. The first 3 items on the IRS's list, phishing, phone scams, and identity theft, are usually based on dishonest people pretexting to gain financial advantage. Oftentimes, these scams will involve someone posing as an IRS agent or employee. The IRS frequently reminds taxpayers that it will never initiate contact with taxpayers through email. Likewise, the IRS will never demand immediate payment of a balance due over the phone by credit card or wire transfer. When the IRS initiates contacts with taxpayers, it does so through regular old snail mail, and they will not contact you by telephone unless they've been given approval to do so. The IRS will give taxpayers several opportunities to dispute or explain any inconsistencies in their tax returns. Typically, a taxpayer will receive several notices and letters before the IRS would issue a levy for their bank account and a demand for payment. So if any of your clients come to you saying that the IRS has called them demanding they make payment or they'll be arrested or something similar, it's likely they are dealing with a scammer. Advise them to alert the IRS about the scammer by calling 1-800-366-4484 or by visiting the IRS's website. Top on the IRS's list this year is phishing scams. These typically take the form of a fake email or a website that collects personal data. Typically, these emails and websites look very similar to legitimate ones. They will contain fake logos, email addresses, or links to fool the receiver. If something feels off about an email or website, it's probably best to avoid it. Phone scams have also become largely popular. I mean, who isn't receiving robocalls these days? These calls will typically involve someone trying to collect personal or bank information from the taxpayer. Another popular scheme involves the caller posing as an IRS agent, claiming that if payment is not made immediately, the caller will be arrested. The IRS does not operate this way. Another thing to note is that the IRS will not ask for a wire transfer or for your credit card number. The IRS typically accepts payments by check or electronically through a secure website. Identity theft is also very high on the list and fits into all of these other schemes as well. It can devastate an individual's financial well-being. This is one of those that taxpayers should be aware of all year long. Remind clients that they should safeguard their personal information and protect their Social Security number, and only give it when absolutely necessary. So the IRS is also aggressively pursuing individuals filing fraudulent tax returns using someone else's Social Security number. Next on the list is unscrupulous and dishonest tax preparers. According to the IRS, more than half of all taxpayers hire help to prepare their tax returns, and every year shady tax return preparers take advantage of unsuspecting taxpayers by collecting high preparation fees, sharing in unwarranted refunds, or engaging in criminal activities. Most Americans do not really understand their taxes and put their trust in their tax preparer to do a good job. But dishonest preparers can mislead taxpayers about credits or deductions that are available to them, causing them to claim credits and deductions that they aren't really eligible for in order to obtain a larger refund. Choosing the right tax professional is critically important because taxpayers are ultimately responsible for what is submitted on their tax return, whether they understand it or not. Look for tax preparers that are well established and have been around for several years. Every year, tax preparers are deceived by dishonest preparers, perpetuating identity theft and tax return fraud. Taxpayers should be on the lookout for schemes that include inflated refunds. If a preparer is promising a refund that is larger than normal with no explanation about how that refund came to be, there's a good chance that it might have been obtained fraudulently. Taxpayers should never sign a blank tax return. They should also ask their tax preparer to explain their taxes to them. Bad tax preparers may inflate income so that certain refundable credits are now available to the taxpayer that wouldn't have been otherwise. Taxpayers should also be aware of preparers that promise a big refund without ever seeing the taxpayer's records. They should also be wary of preparers that base their fees on the size of the refund because they might be more likely to inflate that refund. Or they should also be on the lookout for tax preparers that file false W-2s or 1099s and those that knowingly pad deductions or use averages or guesstimates rather than actual expenses. I've actually had a personal experience with a person that dealt with a dishonest tax preparer. Back when I was working in tax return preparation and helping taxpayers resolve their disputes with the IRS, we had a lady come into our office that kept receiving notices from the IRS. The notices were informing her that she owed a large penalty and interest for claiming dependents and credits related to those dependents that she didn't have. She did, in fact, have one dependent child, but the IRS notice said that she'd claimed 2 additional children and that she had received an extra earned income credit because of those 2 children. She thought that it was a case of mistaken identity and that the IRS was confusing her with someone else. She brought us a copy of her tax return and it matched what she said. 1 child claimed and the proper earned income credit associated with that child. We contacted the IRS about getting a copy of the tax return that had been filed on her behalf, and sure enough, when we got it back, the version that had been filed claimed 2 additional children and an increased earned income credit. So we dug into the situation a little deeper to try to figure out what was going on. She had met the lady that did her tax return at church. The story was that this little lady had just moved to the area and was a certified tax preparer, and that she was looking for new clients. So our client, along with a few other churchgoers, had this lady prepare their tax returns that year. What we discovered was that she was producing a tax return that correctly reflected the information given to her, printing that return, and then giving it to the unsuspecting individual. What she was filing with the IRS typically claimed extra dependents and credits that the taxpayer was not eligible to claim. She was then splitting the refund so that the individual was getting the amount of the refund that they should have gotten had their tax return been prepared correctly, and she was having the additional fraudulent amount deposited into her own bank account. After tax time, but before any of the churchgoers started receiving notices, the lady moved towns, and of course, she failed to leave any of her contact information. The IRS was not very sympathetic to our client's plight at first, but when they discovered that this was widespread, that the lady had done this several different times in several different areas, they were more willing to listen to our client. We didn't get to find out exactly how everything ended up for her because it became part of a federal investigation, but I can tell you that it cost the taxpayer a lot of time, money, and grief to even begin to sort it all out. The lesson is that unscrupulous tax preparers can come from anywhere, and they can be anyone, even the little lady sitting next to you in church. Cases like this illustrate how important it is to make sure you have a good and legitimate tax preparer doing your tax returns. The IRS knows that it's not always the tax preparers that's committing these falsehoods. Sometimes it's the taxpayer themselves. The IRS is warning taxpayers that they may take a closer look at these things. The service warns against taxpayers claiming business expenses for what are really personal expenses. It's often seen with fuel expenditures. Say, for instance, a business owner uses their own car for both personal and business use. The business owner is supposed to track what part of their fuel expense is used for business versus personal. Business owners are not allowed to claim fuel expense for their business on what was really personal use. Another common problem is taxpayers inflating deductions. Taxpayers are only allowed to deduct actual deductible expenses. They should not be exaggerated or inflated for a larger deduction than allowable. This is often seen with charitable deductions. Because it was on the IRS's Dirty Dozen list, it might be a hint that the IRS is looking into these things with a little more foresight than they have in the past. The next number on the list is frivolous tax arguments. No one likes taxes, but they are a necessary part of how our country operates. Unfortunately, there are still people out there that think the tax code does not apply to them. They try to argue that taxes are illegal and that U.S. citizens are not required to file or pay taxes. The IRS has prepared a substantial piece on such arguments and why they are not successful. It also provides real-life examples. The piece can be found on the website listed on this slide. And if civil penalties and fines aren't convincing enough, perhaps the Wesley Snipes case is. Wesley Snipes had to spend 3 years in jail for tax evasion. So it was a pretty serious offense to actually get jail time, but it shows you that it can and does happen. Next on the list is abusive tax shelters. Tax shelters are used to avoid paying taxes. The IRS is now cracking down on these types of plans and giving them a higher level of scrutiny. In this year's list, the IRS specifically points to captive insurance shelters. This type of plan typically allows a business to insure itself against losses by creating its own captive insurance company. If the captive operates according to law, it allows the business to deduct the premiums paid to the captive. But captives have to meet specific guidelines to operate correctly, and the need for the insurance coverage has to be legitimate. What often ends up happening is that the taxpayer does not understand the intricacies and laws regarding operating a captive, or the scheme lacks many of the attributes of genuine insurance. The fact that captives were specifically pointed out in the Dirty Dozen list underscores the extra risk a taxpayer is taking on by taking part in this type of tax shelter. Taxpayers have been trying to hide money away from the service in offshore bank accounts for years, and the IRS knows it, and is cracking down on those offshore funds. Often, foreign banks and other investment entities do not report taxable income of U.S. citizens to the IRS. Because of the historical lack of reporting, it is easier for taxpayers to hide overseas income from the service, but doing so risks criminal prosecution. Sometimes these schemes are quite elaborate and include shell companies and intermediaries. As foreign investments earned money, taxpayers would use the offshore entities as piggy banks and would fail to report the income to the IRS. But federal law requires taxpayers with foreign investments to report the transactions to the IRS, regardless of whether or not the foreign bank reports anything. The IRS recognized that many taxpayers with foreign accounts have failed to do this in the past. So, the service introduced a special program called the Offshore Voluntary Disclosure Program so that U.S. taxpayers could voluntarily resolve past non-compliance with the federal laws. Another concern for taxpayers are fake charities. Fake charities have also made the Dirty Dozen list this year because they are rising in popularity. It specifically warns that groups are getting better and better at making themselves look like they are legitimate charities. They may have one letter off in their name. They might have a similar logo. They may even have a website that looks legit and or very similar to the real charity's website. Advise your clients to be on the lookout for fake charities so that they do not give their hard-earned dollars to schemers. Money given to a fake charity is not deductible. Only contributions given to real registered charities are deductible. The IRS has provided a search engine so that taxpayers can search for legitimate charities, and it's included on this list as well. Financial professionals help their clients in several ways by preserving wealth and protecting hard-earned money from taxes, liabilities, and market losses. It's easy to forget that there are other things out there that can deplete those monies, and schemers and scammers are all too eager to take advantage of unsuspecting taxpayers. Clients can lose money through phishing, phone scams, identity theft, and to dishonest tax preparers. Clients can also potentially lose money if they try to skirt around IRS rules by inflating deductions or claiming credits that they are not eligible for, because the IRS will pursue and penalize and fine taxpayers that try to cheat. Helping clients avoid these scams, schemes, and pitfalls is also an important part of wealth preservation, and it will help your clients' peace of mind as well as their pocketbooks. That's all for today, and I will turn it back over to Linus.
Thank you, Jennifer, and thank all of you for joining us today. As a reminder, if you would like to receive supporting materials, feel welcome to email us at asktheexpert@advancedunderwriting.com. That's asktheexpert@advancedunderwriting.com. You may also email questions related to today's webinar. Feel welcome to join us for the next webinar on the first Wednesday of next month, Wednesday, August 1st, at this same time. Next month's webinar will be titled Recent Developments on 60-Day Rollovers. You can also find an archive of past webinars on our YouTube channel. Today's presentation will be posted on our YouTube channel by the end of today. And finally, for more information about the services that Advanced Underwriting Consultants offers, including phone consultation and newsletter licensing, feel welcome to contact us at 615-224-1291. That's 615-224-1291. Thanks again, and best wishes for continued success.